If you want to find out about Wall Street's new favorite dangerous derivative product, watch this video. Apparently nobody learned any lessons from 2008. Derivative products are dangerous. Investors are purchasing less of the same types of derivatives that caused the financial crisis, but do not be deceived. They are still putting massive amounts of money into derivatives, just a new set of monsters. Here we go again. You came here for the truth, so let me unveil that for you. Today we are going to talk about the CLO. That's the Collateralized Loan Obligation. You may have heard of the CDO, or the Collateralized Debt Obligation. Well, now today we're going to talk about this new monster that has hit the stage as the most popular choice for investors. Of course, the collateralized loan obligation isn't entirely new, but it is now front and center on Wall Street. I'm going to read you the first sentence of this paragraph, and I want you to think about how this could possibly be reasonable to exist. What is a collateralized loan obligation? A CLO is a single security backed by a pool of debt. Those who are deeply rooted in the financial industry believe that it is okay for this product to exist. However, some that are wise enough have realized this is complete insanity. Look at what happened in 2008 as a result of everything related to the derivatives products. Often these are corporate loans that have a low credit rating or leveraged buyouts made by a private equity firm to take a controlling interest in an existing company. They mention how it's similar to a collateralized mortgage obligation. Instead, there's a different type of debt, in this case being mortgages. It's all the same thing. You take a whole bunch of garbage, you pile it up, and you sell it to an investor. You cannot successfully do this over a long period of time without having an issue. I'm going to show you a diagram in a second, but basically when one of them starts to go, because of course you have all of these pieces of debt within this package, then the cracks start to appear, and then a second one goes, and a third one goes, and a fourth one goes, and suddenly you have a very big issue. This is out of the Financial Times. How collateralized loan obligations work. Number one, banks sell the loans that they have created to a CLO manager. You could see that at the top. Number two, the CLO divides the loan's risk into various levels. So it goes from AAA all the way down. However, I need to interject that we saw what the AAA rated investments were just 10 years ago. It was all a fraud. The agencies knew how bad the loans contained in them were, and yet they still rated them AAA. But of course, it doesn't even matter if those ones aren't an issue, because the ones at the bottom are the ones that tend to fail most often. And this is what I worry about with derivative products. You always have this being an issue. Take, for example, right now, early 2019, how we see the auto loans and the delinquencies rising. Well, some of those loans are going to be rated B, double B, or triple B, let's say, and they start to go. They start to default. And that means that all of these derivative products that they're a part of are going to start to fail. One by one, it's going to escalate. So looking further into this, number three, as the loans are paid off, the income flows to the buyers of the CLO. Number four, investors at the bottom of the pile stand to make higher returns, but also run a higher risk of losing money. That, of course, is when everything is working normally, but when you start to have that domino effect, it will become an issue, not just for those at the bottom of the barrel, but of course for the entire product. And then you have to understand how these companies are interconnected. I often see people who don't understand anything about the financial industry, and they simply feel that their investment, whatever it might be, is totally safe and sound from derivative products. I even had a conversation with an individual who works exclusively with high net worth clients, and they believed that they were shielded from derivatives because they don't go near them at all. This is the unwise, complete lack of knowledge on the part of those within the financial industry. Everything is connected today, and that goes across borders. People feel that wherever their country that they currently reside in is somehow unaffected by what happens outside the borders. Do they know a single thing about the financial industry? There are no borders in the financial industry. That's silly. And this is particularly pronounced with derivative products. Let's take a real example. A peek inside the CLO factory. Tool retailer Harbor Freight Tools refinanced a $2.2 billion loan this year. Much of it ended up in hundreds of CLOs. So you have a $2.2 billion loan refinanced by Harbor Freight Tools. The debt is sold off, and it looks like nearly $1 billion worth. Minimum share of loan held by CLOs. Then it goes below that. Portions of loan held by hundreds of CLOs, which is then sold off to companies like BlackRock, for example. So you could go through the whole process and see it for yourself. But essentially what we have here today is no different than any other derivative product. It's very similar in a way to all of these mortgage-backed securities, asset-backed securities, collateralized debt obligations, CDO squared, CDO cubed, and all of that. You have an underlying asset that's a minuscule amount of what they have created, and then they put this huge, gigantic thing on top of it, and nobody even knows where the underlying asset is anymore. It doesn't even matter. As long as everything keeps moving, as long as the machines keep turning, you're not going to have a problem. But every so often, you do. This is directly from the Money GPS. And I have this very simple diagram. I have several in the book, but this is one of them. And I talk about a CDO as an example, but basically any derivative product. That's what we're looking at. So essentially what we have are car loans, mortgages, credit card debt. They take it, they package it up, call it a CDO, and they have their friends at the rating agencies label it AAA. And that led to the financial crisis because everything started to unwind. You had all of these different companies who were relying on another company for one reason or another. And that started to break down and was extremely dangerous and almost resulted in the entire financial system coming to a halt. Sadly, none of the issues were actually resolved. At this point, there have been no resolutions to what we saw in the financial crisis. They simply papered over it, printed a whole bunch of money, did TARP bailouts, quantitative easing, and a whole bunch of stimulus. Big mistake, because of course, that means next time it's going to be worse. This right here is from Deutsche Bank, and what you're looking at is a CLO. On the left-hand side, this is the origination. What it's showing you here is the underlying loans and how that moves into a CLO. So there's different sections, different ratings, AAA, AA, and so on. On the right-hand side, you can see how some of them begin to fail, and that can take the entire derivative product down. If one of these derivatives start to fail, then the company starts to fail, then everybody interconnected starts to go down, and we have a much worse problem than 2008 on our hands. I hope I made myself clear what a CLO is and the dangers that they pose, but it's just one example of a derivative product. I really don't think it's any different than all of the other ones. What makes it worse in a way is that you don't even have, for example, a house at the very deepest level of this. You basically have nothing. So this is a worthless product that will, of course, eventually end in ruin. If you're interested in finding out more about derivatives, I have an excellent video that's in my free e-course. Just stay to the end of the video here and you're going to see the link for that. It's important to understand this, but it can be very convoluted, very complicated, and I did make it simple in that video, so stay tuned. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you are supporting this channel, so I do appreciate that very much. If you want the financial education that was not taught to you in school, these two books have everything that you need, from the foundation and the asset classes, talking about all of that, but I also get into the derivatives. I talk about what happened during the financial crisis and all the history prior to it. You can check these books out at the link in the description if you want the audiobook that's available at themoneygps.com. If you want a more in-depth explanation about derivatives, just click on this video and I explain it in full, so I'll see you there.